A very good day and welcome to all of you watching this video. Snapshot review of the strategic pre-theme relevant to the November 2014 exams for E3, F3 and P3. I, Vignesh, on behalf of Phoenix, will be reviewing the pre-theme released by CIMA, which is now available on the CIMA website, and which will form the basis of question 1 of the 3 strategic exams in November 2014. For those of you writing this exam, besides the content in the pre-theme, you will also have an unseen passage that runs into a couple of pages, and the question requirements for 50 marks are based on the pre-theme passage as well as the additional unseen that's given to you in the exam. From past experience, it is evident that sometimes the unseen passage throws up information which leads on to questions which are quite unexpected and contrary to predicted lines or questions based on the pre-theme. So, what we will intend to do is have a look at the scenario, think of all possibilities, and at the end of that, I would encourage all of you to go back and continue thinking about further possibilities. And through this thought process, by the time you get into your exams, you would possibly be in the best position to answer any requirements that are put forth in question 1 across E3, P3 and F3. So with this in mind, let's move on to the review. The company given to you in the scenario is a confectionery that was set up in the year 1990, which means the company has been in existence for a very, very long time and has been fairly successful and a very common household name, which indicates a very strong brand image. And what is also very evident from the first paragraph is the fact that they offer, or they are known for offering, very high quality products, which is probably indicative of the fact that based on Porter's generic strategies, this particular entity can be classified as a differentiator. Why is that important for us? For the simple reason that if you are asked to evaluate new strategies, if you are asked to consider the viability, the feasibility of new opportunities that the company intends to explore, it is critical that these new ideas are consistent with this broad generic strategy. What else are we told? We are told that they operate globally, but when we read further, you will observe that the question says, or rather the scenario states, that the largest market for the company is within Europe, which sort of throws up an opportunity for the company. Your unseen passage could very well bring up the possibility of further expansion into other parts of the world. Coming back to the first paragraph, the scenario also talks about a hybrid model for the company, And when I say hybrid, I mean there are certain stores that the company operates that they own by themselves, whereas some of the stores that they operate work on leases. The fact that the company owns a few stores indicates that it has certain tangible assets, and from an F3 perspective, could that be used as security for further financing? You could possibly expect a question on raising further finance for the operations of the company, and I'll tell you in a while why that is more relevant to the given scenario. If you read on to paragraph 2 of the scenario, it gives you further clarity on how the organization operates. The products are all manufactured in its factory in a European country, which means goods are all shipped or transported by other means to all its global locations, to the other parts of Europe. Now, is that an appropriate model for operating your supply chain? There could be a possible unseen scenario where they consider operating from multiple locations rather than a single location. Is that suitable? Is that something that's feasible? How will it affect the entity's performance? Will that have an impact on quality? Will it reduce the environmental effects arising due to longer distance to transport their products to reach other markets? A possible angle from an E3 perspective. Further, we are told that Y operates through owned stores, which we already know works on either a lease model or on owned stores. They also have an online business, and they also work through franchises and retail partners. In addition, they have started to supply to large retail stores and supermarkets on a contract basis. And what is interesting here is besides selling to these supermarkets under their own brand name, as in under Y's brand name, they also make and sell products using the brand name of the supermarket. We are further told that the company has a wide range of products. They talk about the basic confectionery and even outside chocolates. They also make other confectionery like cakes, candies, etc. And when I look at this, I am inclined to believe that given the multi-product mix within the company, could there be potentially a BCG analysis? You have multiple products with varying degrees of market share, with differing future potential. Maybe there is a possibility from an E3 perspective that you could be asked to do a BCG analysis for the various products that are outlined there. Now, besides the stores that the company operates, another channel through which sales are made is direct sales to corporate customers or corporate clients who buy Wise products to give out as corporate gifts. And that assumes a lot of significance in the scenario, because as we go further, we are told that one of the opportunities, or rather I would say, objectives of Y is to deseasonalize sales, as in to have sales across the year. Maybe that might be through rebranding the products of Y. You don't just sell during the festive season, say during Christmas, during Eid, during Diwali. They try to sell across the year, probably by rebranding their products as birthday gifts, as wedding anniversary gifts, as thank you gifts for regular events. And there is definitely an opportunity to further enhance the sales of Y by concentrating on this target market, the corporate market. There's a little bit of information in the scenario there on the organizational structure. They have a head office and further two divisions. One, the direct customer sales department or the division, which takes care of Y's own stores, which are either owned or leased. It also takes care of the franchises and the online sales. On the other hand, the manufacturing and commercial division takes care of the making of the products and is also involved in the supply to corporate clients, which we did sort of discuss briefly earlier. And besides that, they also sell to the retail stores and supermarkets under both Y's own label and the labels of the supermarkets and retail stores. Now you've got to appreciate that MC are the guys who make, or is the division that makes the product, and they obviously need to transfer it to the direct customer sales department so as to enable them to pass it on to the franchises to sell online and so on. So definitely there is a transfer pricing angle to the question. Further, we are told that both divisions are treated as investment centers, and yet again I'm thinking of E3 divisional performance assessment. Whenever you talk of investment centers, the use of measures such as residual income and return on investment are the first things that I can think of. However, the scenario further goes on to say that the managers of the individual divisions, whilst they are treated as investment centers, they do not have the capability, or rather the authority, I would say, to spend on capex of more than 10,000 euros per item. Now that's kind of a mismatch, isn't it? An investment center is typically a segment of the organization for which you would assume that the divisional managers have autonomy over decision making on aspects of revenue, cost, as well as investments. So you could potentially have a discussion there on the appropriateness of this control system that we see there. If they are being controlled using measures like ROI, RI, is it really appropriate? And what are the deficiencies of the current control systems? Probably if the scenario is supplemented with a bit more of information on the control systems in the unseen, there's potential for a question on these lines. Further, moving on to the next page of the scenario, we are told that as a result of the decline in the high street sales, Y has reduced the number of its own stores and wants to expand other sale outlets. And that potentially means here's a company that probably wants to work through franchises, maybe push the online sales model better, more aggressively. And that opens up a lot of potential questions, both from an E3 as well as an F3 perspective. From an F3 perspective, could there potentially be an investment appraisal question, maybe? When they talk about further investment in online sales? There could also be an E3 question on evaluation of this particular strategy using a model such as the SFA test maybe. There could probably also be some form of an analysis of the performance of its own stores in comparison to that of franchises, maybe something on the lines of a cost-benefit analysis. On a paper like E3, you do observe that about 10 to 12 marks of numerical elements do come in, even on E3, and that could form the basis of an evaluation of strategy. Should we really move from the traditional own store model to more of franchising or more of online sales? There could also be a potential E3 question. That's what is really amazing about the scenario. There's just so much of sort of angles. There are so many angles to the E3 questions that can come on the basis of the scenario. There could potentially be a question on benefits of being more aggressive and selling via electronic means, the benefits of e-business, how it can create more opportunities for you. There's also a mention of why it has been able to develop its online sales business and introduce click and collect services using its stores and franchise business as collection points. Maybe that could be developed further. Could there be again an investment appraisal question linked to this? Let's look at it a step further now. Let's go on to the next paragraph, where they talk about Y's mission, which ultimately ties in with the differentiation strategy that we identified earlier. The mission of the company is to delight customers by providing luxurious products which strengthen the brand. So all of these ideas basically reiterate the fact that we are, or Y is, a differentiator. And anything and everything we do must ultimately be consistent with this mission of being able to keep our customers happy. Further, you are told that the company wishes to increase shareholder wealth or value by improving margins through increased sales and reduced cost. There definitely exists a possibility for some sort of a financial analysis. They could come up with a proposal and say, what's the impact on shareholder wealth? Probably a typical, I know that's a bit non-conventional, but that could be a potential F3 angle. Further, as I did sort of mention very briefly earlier, here's a mention of the fact that Y is now placing great emphasis on trying to de-seasonalize its sales. And a large part of that probably involves rebranding itself. To start thinking of how can I change the perception of chocolates being a seasonal product, a gift for certain occasions. How can I encourage people to buy more often? Could there be, from an E3 perspective, there's definitely a potential question on marketing channels maybe? They could very well bring in that into one of the subparts of the first question. Now, reading further, you are given two strategic objectives which Y intends to use to achieve further growth. One, it wishes to engage with the widest range of customers through the development of Y's markets. And that throws up an S3 scenario all of a sudden. And also, although there's very little from a P3 perspective on this particular scenario, I believe from a P3 perspective, there's got to be a lot of information given to you in the unseen. This does open up, this particular paragraph opens up possibilities from all three papers, both for E3, S3 and P3. Let me talk about S3 first. There could be a potential question on acquisitions, because one way of growing into newer markets is through acquisitions, and there you might be asked to attach a value to a potential acquisition target. From a P3 perspective, could they talk about a new strategy of expansion, ask you to identify potential risks associated with a particular strategic route and how you are going to probably overcome, or can I say react or respond to these risks? That's potentially a P3 angle to the question. An E3 angle, as always, SFA or suitability, feasibility, acceptability is a very, very common question. You have so many potential opportunities for this company to grow. Each of that could very well be the basis of an SFA analysis or subject to the SFA test. We are further told that the company wishes to enhance the customer experience through strong and effective customer relationship management. Could they probably bring in elements of customer relationship management? Maybe ask us to talk about how the relationship can be improved, or maybe sort of come up with ideas on what they think will help them achieve better brand loyalty and retention, and ask you to evaluate certain ideas in this context. You might say, these are things that we're going to do. We're going to come up with loyalty cards maybe, promotional offers, something on these lines, and then they could ask you to evaluate the efficacy of these ideas. Reading further, we are told about the divisional structure of the management structure of the organization. The board has a non-executive chairman, a newly appointed CEO, the managing directors of the two divisions, namely the direct customer sales and the manufacturing and commercial division, the finance director, and three non-executive directors. The company applies good corporate governance principles and practices, and the board has a committee structure which includes an audit committee, which basically yet again is an indication of good corporate governance. And often from an exam scenario, what you want are problems. So that's what gives you different angles to the question. And from a P3 perspective, everything looks very much in line with the best practices. And hence, which is why, as I mentioned, it's probably got to be much more on the P3 unseen passage than what you can probably see from the pre-seen. Because unless new problems are thrown into the question or something new is brought into the scenario, it's really hard to predict which way the P3 scenario would go. Let's read further. The scenario goes on to say that the divisional structures reflect the different activities. The MD of each division has a team comprising of 3 regional directors covering the functions of finance, HR, and IT. In addition, the DCS has 3 divisional directors, one responsible for Wise stores, franchises, and online sales. In addition to the divisional directors, the MC division has 3 divisional directors, one responsible for procurement, one for manufacturing, and one for commercial clients, retail, and supermarkets. Now, it is obvious that if the company intends to increase its sales through franchises, through online sales, and improve focus on commercial clients, there is obviously possibly a need for, can we say, the responsibilities to be shared between a few more directors in the board maybe. You might need more heads, particularly to take responsibility and to bifurcate the responsibilities for supermarkets, retail stores, and commercial clients. Further, in the financial overview, we are told that in the last financial year, Y achieved an operating margin of 12% and a profit after tax of 7.7%. Despite its best efforts in heavily reinvesting, Y's bottom line profit has stagnated, which means they are desperate for newer means and methods of growing. And this is where the idea of acquiring foreign subsidiaries comes into play. Or it might be a case of organically growing in newer, more, can I say, the emerging markets, say something like China or India maybe. And when compared to the forecast, the current year's performance is not looking as promising. And a very key sort of element in the scenario, which I think is very, very relevant from an S3 perspective, is the fact that a lot of Wise borrowings are due for repayment in 2015, and that throws up a question on what are the sources of finance that a company can raise, maybe a question on weighted average cost of capital. So you could potentially have a scenario where they give you new sources of finance or the existing sources of finance, ask you to compute the WACC, talk about what are the new further opportunities for refinancing the business when these borrowings become due in 2015. Now, given all these concerns, the board of directors have determined the following financial objectives. Now, what have they said? They've said that the company needs to operate on a sound financial basis, increase profit, meaning we need to grow, and shareholder value. and they need to pay a regular and consistent dividend each year. So they want to maintain the dividends year on year, and which obviously means from the point of view of retained earnings, there is a limit up to which you can hold the funds. If you've been paying a certain level of dividends over the past few years, you need to keep that there. The board seems to want to maintain that. And any refinancing of the business, any financing not just for existing operations but for growth, probably needs to be predominantly external sources of finance. From an environmental and a CSR perspective, why does aim to carry out its business with little damage to the environment, and they want to operate in a fair manner to all its stakeholders. When we talk about fairness to stakeholders, I want to go back to a paragraph which probably I didn't neglect, but I just sort of ignored temporarily. This is the first paragraph on the second page, where you are told that the company has been reducing its number of stores, and this has resulted in some staff being retrained and redeployed. Meaning, they've tried to avoid redundancy, sending people back home. They've tried to use them elsewhere within the organization, which I think partly stems from this culture within the company of being responsible and fair to all its stakeholders. Now, having said that, if you are intending to close down more stores, at some point employees are going to be affected. Not just employees, other stakeholders are also going to be affected. There could potentially be an analysis of the impact on stakeholders and how stakeholders would react and how you would manage the aspirations and the stakeholder conflicts if at all you are intending to close down stores. You might need to evaluate, is it a good idea? From the point of view of all the stakeholders. They're obviously, from the shareholders' perspective, probably you should close down. From the employees' perspective, probably it's a bit of a dicey situation. So you may be asked to perform a Mendelow's matrix analysis maybe, and try and understand whose priorities need to be, or whose objectives need to be prioritized, how they would react to a particular strategic route pursued by the company, and how and what means we could use to overcome any potential stakeholder conflicts. Coming back to the environmental bit, having spoken about the fact that the company has so far been very fair with all stakeholders, you are told that it is keen to ensure each of its suppliers adheres to highest ethical and environmental standards with regard to sources of material and treatment of employees. Why import cocoa from Africa and Indonesia? Why has initiated schemes to encourage sustainable farming of cocoa, and farmers are being trained in effective agricultural methods? The introduction of an industry-approved certification program has enabled farmers to achieve higher levels of income from increased production and to access additional training directed at improving their production yields. Now, obviously the company is doing a lot to also ensure that its suppliers, meaning the the farming community, the farmers of cocoa, are given their fair share of benefits. And they also get to benefit from the involvement with why. So you might say, is that really the business of why? There could be an argument, and that stems from the ethical stances that a company might take. If the company were to have a short-term shareholder interest in mind, they would say, this is not my job. But that does not appear to be the case. You could potentially be asked a question on the ethical stance that the company has adopted, the implications that it has on shareholders, having such a model of helping and encouraging training for its suppliers, etc. Whilst in the long run it might be a model that gives wide benefits, in the short run definitely it is going to erode profits, increase costs for the group. All raw materials are sourced from Africa and Indonesia in USD. That definitely opens up the possibility of an exchange rate risk or a forex risk question. From a P3 perspective, all of Y's products contain only the ingredients listed on the packaging. The packaging also shows nutritional content and gives advice on recommended volumes of consumption. Y tries to ensure that the packaging used is recyclable and kept as minimal as possible to balance concerns over material usage with commercial marketing requirements. There's a bit there on how the lighting within the factory is environment friendly. And how could all of this be put into a question? Maybe there's definitely an E3 angle talking about the importance of, I wouldn't say ethics, but about sustainable practices such as this. How is it going to help the company? They might come up with new ideas in the scenario, and you might be asked to assess the consistency of these ideas with all that the company now does, with the objective of minimizing the impact on environment. Some of these ideas could contradict these objectives of the company wanting to minimize the impact on the environment. Y has introduced annual independent health and safety audits in the factory and retail outlets. That throws another P3 angle to the question. They might want to talk about the tasks, or can I say the objectives of such an HNS audit. All factory staff have undertaken food safety and health and safety in the workplace training at required industry levels. Workplace benefits such as medical insurance, staff discounts, as well as competitive salaries are offered to all of Y's employees. There could also potentially be a question there on the need for audits such as this. Why do you need it? What's the purpose? Is it consistent with what the company wants to achieve? And another interesting angle I think you can read from all that you've read so far is, if the company intends to expand into foreign markets, it is obvious that the political factors, and I would say to a greater extent, the legal and the environmental regulations are going to be very, very, very different. And this is something that could form the basis of a question. Yes, they are following best practices in the country they are operating in. If they try to duplicate that elsewhere, is it still going to be in compliance with the local regulations, the legal framework? Further, in order to achieve its objective, Y intends to expand its online sales and corporate client sales and the external retail retail stores and supermarket, which is sort of what we've been speaking about earlier as well. They want to reduce the number of stores, focus on its franchise, probably less on franchise, but online sales and retail stores and supermarkets. This just confirms our understanding of what we thought the company's strategic direction would be. Further, you are told that these markets yield higher margins than the high street stores for the simple reason the overheads are bound to be low. And very clearly there's an intention, the board intends to further rationalize the number of high street stores. And that sort of takes me back to what I put down here. If we are going to close down any of the stores, what's the impact on stakeholders? So given the organizational structure there, which we've already discussed, on the financials there, I just want to probably point out that the current and non-current liabilities in the scenario add up to around 154 million euro, and we really don't know what proportion of that is outstanding, or can I say due, in 2015. It's obviously not going to be the entire amount, but a substantial portion of that, I suppose. And as against that, we probably have very little cash on hand available. When you think of it from an F3 perspective, think of sources of financing. Maybe you might want to think about the current gearing, the availability of security of assets within the company. If you're planning to close down your high street stores, well, that could possibly be a source of finance. You might sell some of your stores and at the same time you lose assets which could have been used as security for raising further finance. A significant portion of the current assets is in inventory. Could you maybe have something on the lines of inventory management, on working capital management? Why only inventory? Why not receivables? That's also a potential angle. But for all of this, you definitely need more information in the unseen passage. You could have a question on receivables factoring, receivables management, and you can see there are plenty of angles to a question that can come up in your exams. So this is a snapshot review of what we consider to be most relevant in this pre-seen scenario for November 2014. I'd like to take this opportunity to wish all of you the very best for your exams. And hopefully you will progress on to the strategic case in 2015 and qualify as members of CIMA very, very shortly. So I hope this presentation has been useful. Your feedback is welcome. My contact email address is on screen right now. Good luck and thank you.